Breaking reports. U.S. and Israeli forces have launched operations against Iranian targets. Emergency measures activated across the region. China and Canada evacuated citizens days ago. And now it's happening. Markets are reacting violently. Gold spiked $80 in hours. Silver gapped limit up on multiple exchanges. Crude oil jumped 8%. And I keep asking myself one question. If geopolitical analysts saw this coming, if evacuations happened last week, if markets already priced in the risk as some claim, why is panic selling hitting equities while precious metals are exploding? My theory is this. Markets never fully price in war. They price in the possibility. But when missiles actually fly, when conflict becomes real, psychology shifts instantly from calculation to survival. And that shift is what creates the opportunities. Let me show you the pattern, because we've seen this before. And every time, two groups emerge. Those who positioned before the chaos, and those who panic bought at the top. I'm not a financial advisor. This isn't financial advice. This is real-time pattern analysis based on emerging geopolitical developments, market positioning data, and historical precedent from prior Middle East conflicts. And what I'm seeing right now suggests we're in the opening phase of a volatility event that could last weeks or months, depending on how this escalates. Let me give you the framework first, because understanding the pattern is the only way to navigate chaos. 4 stages. Every geopolitical crisis follows this sequence in financial markets. Stage 1 is anticipation. Intelligence reports surface. Diplomatic tensions rise. Analysts warn of potential conflict. Markets get nervous but don't panic. Volatility increases slightly. Safe haven assets drift higher. But most investors stay positioned in risk assets because war might not happen. Stage 1 is when smart money starts hedging quietly. The VIX might tick up from 12 to 16. Gold adds $30 or $40 over weeks, not hours. It's gradual. It's dismissible. And that's exactly why most people miss it. Stage 2 is ignition. Conflict actually begins. The first strikes, the official announcements. And markets don't ease into the reality. They gap. Gold jumps $50 to $100 in a session. Silver limit up. Equities down 3% to 5% at the open. Crude oil spikes. And everyone who thought the risk was priced in realizes it wasn't. The gap happens in the first hours of trading after news breaks. There's no gradual adjustment. It's immediate repricing of risk. Stage 2 is the initial shock. This is where we are right now based on the reports I'm seeing. Stage 3 is volatility and repositioning. After the initial gap, markets don't move in one direction smoothly. They whipsaw. Gold spikes, then profit-taking hits. Silver surges to upper circuit, then corrects 10% the next day. Why? Because traders are divided. Some think the conflict will be short and markets will recover. Others think it escalates and safe havens go much higher. This creates violent two-way action. You'll see gold up $60 one day, down $80 the next, then up $90 the day after that. The net move over a week might only be $20, but the intraday swings are massive. Stage 3 is the most dangerous phase for traders. It's also where the most money is made or lost, depending on risk management. Stage 4 is resolution or escalation. Either diplomatic efforts contain the conflict, markets stabilize, and safe haven premiums fade. Or the conflict expands, draws in more actors, disrupts energy supplies, and safe havens enter sustained bull runs. We won't know which path this takes for days or weeks, but understanding that both outcomes are possible and positioning accordingly, that's the key. Now let me show you what's happening right now in markets. According to reports, gold on COMEX has already risen approximately 1.5% to 2%, testing levels around $5,300 per ounce. MCX gold, Indian market, is approaching record territory. Silver is showing even more explosive moves. On MCX, silver rallied sharply, and some analysts are calling for tests near 95,000 rupees per kilogram, roughly $295 per ounce equivalent. That's upper circuit territory. The trading mechanisms in India have automatic circuit breakers that halt trading when moves exceed certain thresholds. When silver hits those breakers, it tells you the move is extraordinary, not normal volatility. But here's the critical question. Is this the beginning of a sustained move, or a spike that gets sold? Let me show you both perspectives, because understanding both sides is essential. Perspective 1. War premium is real and sustained. The argument goes like this. Iran-Israel conflict isn't contained. It involves US forces. It threatens Strait of Hormuz, a choke point for 20% of global oil supply. If that strait closes or is threatened, crude oil could spike to $120 or higher. That drives inflation fears. Central banks can't cut rates in that environment. Real rates go negative. And gold and silver benefit massively because they're inflation hedges and safe havens. Under this scenario, gold tests $5,500 to $6,000 in coming weeks. Silver could run to $110 to $130 on ratio compression and safe haven flows. The institutional buyers who've been accumulating quietly for months will hold through volatility because they're positioned for this exact scenario. This is the bull case. Perspective 2. Markets already discounted the risk. This view says evacuations happened last week. Intelligence suggested conflict was imminent. Sophisticated investors already positioned. So when the news broke, the initial gap was the move. Now profit-taking begins. Markets realize that modern conflicts are often limited, targeted, and don't spiral into World War III. Diplomacy kicks in, ceasefires get negotiated, and within days or weeks, risk premiums fade. Gold corrects back to $5,000. Silver falls below $85. The traders who bought the spike get trapped. The smart money that positioned early takes profits and waits for the next setup. Under this scenario, the spike is a selling opportunity, not a buying signal. This is the bear case. Which is correct? I don't know yet. Nobody does. And that's the point. In stage 2 and stage 3, both narratives are plausible. The market is trying to figure out which reality we're in. And until clarity emerges, volatility will be extreme. Now let me show you the historical pattern. Because we've seen geopolitical spikes before, and studying how they resolved gives us probabilities. Not certainties, but probabilities. Example 1. Gulf War, 1990 to 1991. Iraq invades Kuwait, August 1990. Oil spikes from $17 to $40 in months. Gold jumps from $360 to $420. That's a 16% move. But once the war started in January 1991, and it became clear the US-led coalition would win quickly, oil collapsed back to $20. Gold fell back to $350. The spike was real, but temporary. The people who bought gold at $420 thinking it would go to $500 lost money. The people who sold into the spike at $410 to $420 profited. The lesson? If conflict is short and decisive, safe haven premiums fade fast. Example 2. 2003 Iraq invasion. Oil spiked in anticipation, but once the invasion began and initial military success was clear, oil actually fell. The buy the rumor, sell the news dynamic played out perfectly. Gold had been in a bull market already, so it continued higher, but not because of Iraq specifically. The Iraq war didn't create the gold bull market. It was already happening due to dollar weakness and Fed policy. The lesson? Markets often sell the news after buying the rumor. The anticipation creates bigger moves than the actual event. Example 3. 2011 Libya intervention. Oil spiked because Libya is a producer, but the conflict was contained regionally. Gold was already in a bull run to $1,900, driven by European debt crisis and QE2, not Libya specifically. Libya added fuel but wasn't the foundational driver. The lesson? Geopolitical events accelerate existing trends, but rarely create sustained moves on their own, unless they fundamentally alter supply or monetary policy. Example 4. Russia-Ukraine, 2022. This is more recent and more relevant. Invasion February 24, 2022. Gold spiked from $1,900 to $2,070 in weeks, but by April it corrected back to $1,900. Why? Because the conflict, while horrible, didn't directly threaten global energy in the way Middle East conflicts do. Russian oil kept flowing through various channels. Sanctions had loopholes, and central banks were tightening policy, which pressured gold. The lesson? Even major wars don't guarantee sustained precious metals rallies if monetary policy is restrictive. So what's different about Iran-Israel-US conflict? 3 things. First, geography. Middle East supplies a huge portion of global oil. Strait of Hormuz closure would create immediate supply shock, not theoretical risk. 20% of global oil flows through that strait. If Iran threatens it, even without closing it completely, insurance costs for tankers spike, shipping slows, prices rise. Second, scope. If this involves U.S. forces directly, and if Iran retaliates against U.S. assets or allies, escalation risk is real. Iran has proxies across the region: Hezbollah in Lebanon, Houthis in Yemen, militias in Iraq. A coordinated multi-front response could overwhelm regional defenses and force broader U.S. involvement. Third, timing. This happens when inflation is still a concern, when central banks are trying to ease policy, and when precious metals are already in technical breakouts. The setup is different from prior conflicts. Now let me show you the 2 scenarios playing out in real time. Scenario A, escalation. Iran retaliates, strikes on oil infrastructure in Saudi Arabia or UAE. Strait of Hormuz threatened or closed. Oil hits $110, then $130. Inflation surges globally. Central banks can't cut rates because inflation is accelerating again. Economic slowdown combines with inflation, stagflation. Equities fall 15% to 20% as earnings collapse and multiples compress. Gold gaps to $5,600, then $6,000. Silver runs to $120 on safe haven plus inflation narrative. Physical premiums explode as investors rush to convert paper to metal. This scenario could play out over 4 to 8 weeks. The positioning? Long physical precious metals, short equities via puts, long energy stocks, long volatility. Scenario B, containment. Initial strikes are targeted and limited. Diplomatic channels open immediately. Russia and China pressure Iran to show restraint. Iran signals it won't escalate due to economic pressure and internal instability. US and Israel achieve objectives quickly without triggering regional war. Ceasefire within 7 to 10 days. Oil spikes but falls back as supply isn't actually disrupted. Tanker traffic continues. Insurance premiums normalize. Gold corrects from $5,300 to $5,100. Silver falls from $95 to $88. Equities recover initial losses within 2 weeks as earnings season proceeds normally. This scenario is also plausible. The positioning? Take profits on safe haven spikes, buy the dip in quality equities, hedge with options instead of outright positions, stay flexible. The problem? We don't know which scenario unfolds until it does, and by the time we know, the major moves are over. So how do you position in uncertainty? Let me show you the risk management framework. First principle: Never trade geopolitical events with unhedged positions. If you're long gold or silver going into this, great. But don't add aggressively at the spike highs. Instead, use options to hedge. Buy puts on gold or silver to protect against profit taking, or use spreads. If you're short anything, cover immediately or hedge with calls. Geopolitical spikes can gap through stop losses. Your stop at $5,250 on gold means nothing if the market opens at $5,320. You're filled at $5,320, and your loss is far larger than planned. Protect yourself. Second principle, volatility works both ways. Gold could gap up $100 and fall back $80 in the same week. Silver could hit limit up and then down 8% the next session. If you can't handle that volatility psychologically or financially, reduce position size. It's better to have a small position that you can hold through chaos than a large position that forces you to panic sell at the worst time. The emotional toll of watching a position swing $10,000 or $20,000 in a day will destroy your decision-making if you're over-leveraged. Third principle, distinguish between trading and investing. If you're trading, you're trying to catch short-term moves. That requires tight stops, quick decisions, and active management. You're watching screens, you're reacting to news, you're in and out. If you're investing, you're positioning for the structural outcome regardless of short-term noise. Investors can ignore the daily whipsaws. Traders cannot. Know what you are and act accordingly. Mixing the two approaches leads to disaster. You hold too long when you should exit. You exit too soon when you should hold. Fourth principle, watch the oil market. Crude oil is the key variable. If oil stays below $95, the market thinks conflict is contained. If oil goes above $110, the market thinks escalation is real. Gold and silver will follow oil's signal, so monitoring crude gives you early warning of which scenario is unfolding. Brent and WTI both matter. Watch inventory data. Watch tanker tracking. Watch insurance premiums on shipping. Those are real-time indicators of actual risk, not just sentiment. Now let me show you the specific technical levels that matter. Gold COMEX. The spike tested $5,300. Resistance is $5,350 to $5,400. If gold breaks above $5,400 and holds for 2 consecutive sessions, that signals escalation scenario is in play. Target $5,600, then $6,000. But if gold fails at $5,350 and falls back below $5,200, that's profit taking and suggests containment scenario. Support at $5,100 and $5,000. Below $5,000, the entire rally is called into question. Silver. The spike on various exchanges pushed toward $95 to $100, depending on market. Resistance for silver is around $97 to $100. If silver breaks $100 and holds, the psychological barrier is broken, and $110 to $120 is realistic on momentum alone. But if silver gets rejected at $97 and falls back below $92, that's a false breakout. Support at $88 and $85. Below $85, the rally is invalidated and $80 becomes the next target. MCX silver, for those trading Indian markets. Reports suggest resistance near 95,000 rupees per kilogram. If that breaks and holds, upside to 1 million rupees is possible. But analysts also noted downside risk toward 92,000 rupees if profit-taking dominates. The key is whether the breakout holds or fails in next 48 to 72 hours. Circuit breakers will create artificial pauses, so actual price discovery might take longer than in US markets. Here's what I'm watching in real time. First, news flow. Are there additional strikes? Is Iran retaliating? Are oil facilities being targeted? Satellite imagery of damage. Official statements from all parties. Second, oil price action. Is crude holding gains or fading? Third, equity market behavior. If stocks stabilize after initial drop, that signals confidence in containment. If stocks continue falling, that signals fear of escalation. Fourth, precious metals premiums. If physical premiums over spot explode, that's real demand, not just paper speculation. If premiums stay normal, it's just futures trading. Now let me address the disagreement between analysts. One view says gold and silver spike, but don't sustain because the risk was already priced in. Another view says volatility will be extreme and sustained. Both could be partially correct. Here's how. The initial gap was pricing in the ignition. But whether it sustains depends on what happens next. If conflict stays limited, the gap fades. First view is right. If conflict escalates, the gap expands. Second view is right. The disagreement isn't about analysis quality. It's about which future unfolds. Here's the trading strategy I'd consider if I were positioning. Not advice, just framework. If you're not already in precious metals, don't chase the spike. Wait for a pullback. Gold at $5,300 after a $100 gap is not an entry point. Wait for $5,150 or $5,100 on a correction. Silver, same logic. If it spikes to $97, don't buy there. Wait for $90 or $88. If you're already in, consider taking partial profits at resistance levels, but keeping core position in case escalation scenario plays out. If you're short, cover immediately. The risk-reward is terrible on short positions during geopolitical shocks. For options traders, this is ideal for straddles or strangles. Buy both calls and puts on gold or silver at the money. The volatility will move one side into profit regardless of direction. Just make sure implied volatility hasn't already priced in the entire move before you enter. Check IV percentiles. If gold options are at 90th percentile IV, you're buying expensive protection. Wait for IV to settle. Here's what concerns me most. Some analysts are calling for silver below 2 million rupees, roughly $78 to $80 equivalent, before March. That's a 15 to 18% drop from current levels. Is that possible? Yes, if containment scenario wins and profit-taking dominates. But it's also possible silver goes to $110 if escalation scenario wins. That's a 15 to 20% gain. The range of outcomes is enormous, and that's why position sizing and risk management matter more than directional conviction right now. Let me show you the longer-term structural view. Regardless of this specific conflict, the underlying drivers for precious metals remain intact. U.S. debt at $38.7 trillion, persistent deficits, geopolitical fragmentation, central bank gold buying at 1,000-ton annual rates, currency debasement through monetary expansion. These are structural, not temporary. So even if this conflict gets contained and gold corrects, the longer-term trend is up. This is noise within a larger pattern. The question is whether this noise creates a short-term top or a launch point for the next leg higher. Here's the final question I'm asking myself. If you knew with certainty that conflict would escalate and gold would hit $6,000, would you buy at $5,300 right now? Probably yes. If you knew with certainty that conflict would be contained and gold would fall to $5,000, would you sell at $5,300? Probably yes. But we don't have certainty. We have probabilities. And in that environment, the correct play is not maximum conviction one way or the other. It's balanced positioning that profits from either outcome. Long physical with hedges, options instead of outright futures, smaller size with tighter risk management. The pattern is clear. Geopolitical shocks create volatility. Volatility creates opportunity, but only for those who manage risk properly. The people who survive these events and profit are those who don't get shaken out by the whipsaws, who don't chase the extremes, and who understand that both scenarios are possible until one becomes actual. So here's my view. I don't know if gold hits $6,000 or falls to $5,000 from here. I don't know if silver runs to $120 or corrects to $85. What I know is the setup. War has started. Markets are reacting. Volatility is extreme. And positioning matters. If you're prepared, if you're hedged, if you sized appropriately, you can navigate this. If you're not, if you're over-leveraged, if you're emotional, you'll get destroyed by the swings. The choice is yours, but don't pretend you weren't warned. Geopolitical events don't wait for you to be ready. They happen, and the market moves. The people who prepared win. The people who panic lose. And right now, between these two analyst views, between escalation and containment, between $6,000 gold and $5,000 gold, the truth is we're in the uncertainty phase. And uncertainty is where risk management separates professionals from amateurs. If you want to follow this as it develops, subscribe. Because this situation is evolving hour by hour. News breaks, markets gap, and understanding the pattern, knowing the levels, recognizing which scenario is unfolding, that knowledge is the only edge. The people who see the signals early adjust. The people who don't get trapped on the wrong side. Don't be trapped. Know the pattern, manage the risk, and survive the chaos. That's how you win in geopolitical volatility. Not by predicting the future, by preparing for multiple futures, and staying flexible enough to adapt when reality reveals itself.